Thank you very much for joining me today. I wanted to spend a little bit of time this afternoon talking about some simple charitable giving strategies for today's tax environment. My name is Mike Ruby. I am a shareholder at KerberRose, and I've been a tax shareholder for the past 25 years for the firm. Work with a lot of 1040 clients and other business tax clients throughout the year, trying to be their trusted advisor when it comes to tax planning and their financial needs. All right, so how can we accomplish charitable goals and garner tax benefits in the current tax environment? So some of you may recall at the end of 2017, the Tax Cuts and Jobs Act changed itemized deductions, at least for the time being. I'm not going to say forever because they may indeed change back at some point, but for right now, in 2017, they really increased the standard deduction for single individuals and married couples, such that itemizing for most married couples and a fair amount of single individuals has become, very difficult, if not impossible. Therefore, as a part of that, the ability to take charitable contributions as a deduction has been limited for a significant part of the population. That being the case, there are some strategies that can be used to still gain tax advantages for making those charitable deductions. And that's what we want to talk about today. There's a number of different things we can do. There's a couple of them that are really simple and things that I think most people, depending on their age, can take advantage of. And those are the two that I'll really focus on today. But I'll talk about a few other ones during the presentation as well. The first option we all had available and still have available is doubling up of contributions. Anybody who's over 70 and a half has the opportunity to give directly out of their qualified plan or their IRA through either the required minimum distributions to get up to that level or beyond. We also have the ability to give to local community foundations in a lump sum and then take advantage of making those contributions over a period of time, using some charitable trusts, gifting of appreciated property and or conservation easements, and the one I'm going to spend the most time on today, and I feel is probably the most beneficial for a lot of folks under the age of 70 and a half, using donor advised funds. And I'm going to, like I said, spend the most time on that and go through some examples of that along with the charitable giving out of IRAs. So the doubling up of contributions, pros of that are you're able to get some tax benefit for the charitable contributions that otherwise may not be available to you. So just as a quick example, for a married couple with a $24,000 standard deduction, because our state taxes, real estate and income taxes are capped at $10,000, most people who don't have a mortgage anymore or who don't itemize their medical deductions because they can't get over the adjusted gross income threshold would only have $10,000 in addition to their charity to get over the $24,000 mark. Very difficult. That would require $14,000 charitable deductions to do that. So most people not able to do that in 1 year, and even 2 years, it can be a struggle for some as well. So this one may be advantageous for single individuals because of the $12,000 standard deduction and the $10,000 tax maximum. They might be able to get to the threshold a little bit easier than married couples. Not going to spend a lot of time on this one today. Pretty simple strategy. If it's applicable, you can talk with your tax advisor about it. Pretty easy to take advantage of this one. The cons of this one, and they've always been cons, are the cash flow to the charity is challenged. So it's a difficult conversation to have with the charity in years when you're not having the charitable contribution or giving to charity. Second strategy, if you are over 70 and a half, this is a really good one. Giving out of your minimum required distributions from your IRA. The pros, the contribution reduces the amount required to be taken into income. So you don't need to itemize in order to take advantage of it. They can effectively reap tax benefits from this approach, otherwise not available. Cons, It's only available to taxpayers over age 70 and a half, and it's limited to $100,000 a year. The third strategy, contributions to your local community foundation. Pros, it allows taxpayers an opportunity to contribute lump sum in 1 year and then give the monies to charity over a period of time. You get your tax benefit all in 1 year, but then can give it over a period of time. So you don't strap the charity with a 1 year contribution and then taking a year off like the doubling up approach. Cons, sometimes the community foundations can have some restrictions that make it a little bit more difficult to get the funds to the charity you want. So you want to make sure that if you're going to utilize this approach, you take that into consideration and do your research up front and make sure that the foundation is going to allow the contributions to the charity you want to benefit. Use of various types of charitable trusts. Many options available here. We're not going to really get into any of those today. If you have any questions on how these might be utilized, feel free to reach out to us after the presentation or at any time to talk about this. But the basic concept is this works really well with appreciated assets, such as real estate or business assets that can be contributed to a trust for the benefit of a charity that could then be sold to minimize taxes. So those assets can be sold within that charitable trust, not incur income tax at that point, and to garner a charitable contribution to the donor, thus allowing them to get that stepped up basis for their charitable contribution. The trust can also provide income throughout their lifetime, which can be advantageous with the principal going to charity after their death. So again, not going to talk about this much today, but just the basics on those charitable trusts. Gifting of appreciated property and/or conservation easements. This has always been a good one. Pros, you can realize 2 tax benefits because you don't pay the capital gain on the appreciated property if you elect to state the fair market value for charitable purposes. There are some limitations on the AGI limitations for this one, but generally speaking, we can plan around that and make it very effective. The charitable deduction is for the full market value of the asset, so you really get a lot of bang for your buck giving appreciated property. Cons can be more challenging unless the financial advisor and a charity can easily work together, which generally speaking in today's environment, pretty easy to work together on that. Sometimes with conservation easements and/or appreciated property that's not very liquid, it can be challenging, and some of the time we can't make that happen. But otherwise, if it's stocks traded on an open market or other very liquid assets, generally not any problem getting those donations accomplished. So using donor-advised funds, pros, it allows the taxpayers an opportunity to contribute throughout the year and receive the benefits while also being able to give their charities money on a regular basis. Cons, the contributions to donor-advised funds are irrevocable and non-refundable. Not really a con. I mean, that one, anytime we give money to charity, it's irrevocable and non-refundable, so it should not be an issue. So more about the donor-advised funds. It's a private fund administered by a third party created for the purpose of managing charitable donations on behalf of an organization, your family, or just you as an individual. They are becoming increasingly popular and allow for people to not only give during their lifetime, but also create a legacy for the future if they want to. We, as a firm in our wealth management area, have chosen to use Schwab Charitable, very, very good, robust platform. Schwab Charitable is an independent 501c3 public charity with a mission to increase charitable giving in the U.S. by providing a tax-smart and simple giving solution to donors. It's got low cost, and there are similar options available through other major providers. So if your advisor, is using a different platform, they should have a donor-advised fund similar to this available in their platform. It allows individuals to minimize capital gain taxes through contributions of appreciated assets, like we talked about earlier. So you can not only garner the tax benefits of giving a large contribution in 1 year so that you don't have to worry about itemizing for a period of time. But you can also give appreciated assets, which you do not have to pay the capital gain on. Very smart tax strategy. You receive a same year tax deduction on the contribution you make to the fund, even though you may not be giving it to charity for 1 year, 2 year, or 10 years. You get that deduction now. It creates an avenue to unlock value of non-cash assets such as real estate, private equity, and other investments. We talked about that. So any of the assets that you could give non-cash in other ways should be available by giving those through Schwab Charitable or another donor-advised fund. You can have all your retirement and wealth resources in one place if you use Schwab's platform. Individuals, businesses, and organizations can open an account. The minimum balance on those accounts is $5,000, so you have to at least do a charitable contribution of $5,000 into the donor advised. Generally speaking, when we're talking about utilizing these vehicles, as you'll see in my examples later, we're utilizing larger contributions. After you set up an account, the ongoing contribution level is only $500, so you can put more money in at a minimum of $500. The grants out to your charitable organizations have to be at least $50. So you're not going to want to use the donor advised fund if you're giving a lot of small contributions of $20 or $25. Generally, you're going to want to use it for anything in excess of that $50. Accounts of $250,000 or more can be professionally managed if you wish. So lots of options available, lots of investment options. So you get investment returns with it, as well as the ability to give to charity and take a deduction for it. Clients can give their advisors the ability to make grant recommendations. You can make international grants. And as I mentioned earlier, you can use it as a charitable legacy program to assist clients who are interested in continuing their charitable giving beyond their lifetime. So they could make a recommendation for up to 6 charitable organizations after they pass on to be able to receive grants for an extended period of time. They may also assign some of their family members to be successor managers or donors to make those decisions after they pass on, whatever the client desires. So the contributions to Schwab Charitable are considered an irrevocable gift and non-refundable. We talked about that earlier. So it is a charitable contribution. So if you make a $50,000 donor advised fund contribution, it is there for the benefit of charity going forward. Deductibility of the contributions depends on the current year tax situation. So if you're planning to do this, we need to make sure that we factor in everything associated with income and deductions for that year so that we can take advantage of whatever we're trying to do from a tax perspective. There are adjusted gross income limitations on charitable contributions. There's different adjusted gross income limitations for certain charities, and there's different adjusted gross income limitations for appreciated assets if we want to take advantage of that tax-free capital gain. If you're contributing real estate or other illiquid assets, they can be accepted through the charitable intermediary through Schwab. Some of these complex assets may not be able to be accomplished, so it would be addressed on a case-by-case basis. Donor advised fund is responsible for all the administration and complying with all the state and federal regulations, so they take that all off your plate. Don't have to worry about any of that. Responsible for all granting and charity due diligence, so you don't have to worry about whether an organization is a 501c3 or not, because there are a lot of organizations out there that try to get charitable contributions sent to them that may not necessarily be a 501c3. Schwab Charitable takes that in their wheelhouse and makes sure that these 501c3s are actual charities. For the legacy program, there's a minimum annual distribution of 5% of the account balance, and the donor can recommend up to 6 charities, as I mentioned earlier. So secure donor site allows for simple grant recommendations, contributions, and research. So I would equate it to your online banking platform. If you're currently using an online banking platform, this Schwab site makes it as simple as that once you get your charities set up in there and established, making a contribution is as easy as logging into your account and identifying the amount that you want to give. You can do scholarships through the donor advised funds at Schwab, but you may not specify the individual recipient. So if you have a scholarship organization, Dollars for Scholars, any of the local scholarship funding mechanisms, you can make contributions from the fund to them as long as they're a 501c3 setup and the decisions are made independent of you. A donor advised fund cannot grant to a private foundation. Multi-year gifts, pledges, and grant agreement capabilities are available. Privacy, the sponsoring charity files an aggregate return that does not detail specific donor names or transactions. Donors can be acknowledged with a special name capability or custom grant letterhead tailored to each grant request. So when you send your grant request in, you would identify whether you want your name to be associated with that charitable contribution going to the charity, which most people do want that. They want to make sure that their church knows that the contribution is coming from them. But if you want to stay confidential, you can do that as well. So there are some fees associated with any of these type of accounts. With Schwab, they range from 0.6% of assets for the administration and management to as little as 0.1% if you have 15 plus million in assets. There may also be investment management fees if you hire an independent investment advisor to help you with it, but if you're going directly through Schwab, this would be the fee schedule. And keep in mind that you are investing in the stock market in the Schwab Charitable Fund, so there will be growth in assets as well as potentially some decline depending on how investments do. So as I said earlier, there's a couple of the strategies which I think are key in today's tax environment. The first of which is anybody who's over 70.5 being able to utilize their IRA distributions, or RMDs as we call them, to fund their charitable bequests. So any of the taxpayers that I work with that are over 70.5, I'm trying to make sure that they understand this provision very well, because in a lot of cases, they're not itemizing anymore because they have their mortgage paid off, may not be paying as much state income or real estate taxes anymore. And most people generally aren't able to itemize their medical deductions. So it can be a really good strategy for a couple of reasons. And I'll illustrate it in this example. So this example deals with a married couple with $180,000 of adjusted gross income, 22% marginal federal tax rate, and both of the taxpayers are over age 65. These people have a tendency to give $10,000 a year, and over a 5-year time period, generally they'll give about $50,000 in total. So when looking at this example, you can see in the year 2020, adjusted gross income $180,000. State taxes between real estate and income taxes capped out at $10,000 for itemization purposes. They might still have a small mortgage left, $4,000 in mortgage interest. And then they give $10,000 to charity for a total of $24,000 of itemized deductions. Our standard deduction in 2020 for that couple being over age 65, both of them, is $27,400. Taxable income would then be $152,600. And you can see 2021, 2022, 2023, and 2024. The same thing generally happens each year. They get close to itemizing, but not quite. So they're not able to really take advantage of any of those charitable contributions that they've made. So over the years, they have 5 years of adjusted taxable income of $759,000. So we'll just leave that there for now. So in the bottom section, I've called that one with planning and charity done through the IRA and no itemizing. So made it pretty simple. We've reduced adjusted gross income because when we give out of our RMD or directly from our IRA, it does not become adjusted gross income. We have to report the distribution as a distribution, but it does not show up as gross income for the tax return purposes. So our adjusted gross income, instead of being 180,000, is 170. And we're going to still take the standard deduction. So instead of in 2020 our taxable income being $152,600, it's $142,600, effectively $10,000 less because of our charitable contributions. over the 5-year time period, you can see each year we're garnering another $10,000 in deductions because we're giving directly to charity from our IRA. So the total for the 5-year time period is $709,000 versus the $759,000 if we do no planning or just continue to give to charity as we always have. Over that 5-year time period, we've saved $50,000 in taxable income or garnered $50,000 of deductions. And then in this example, our marginal tax rate is 22%. So the total savings over that 5 years is about $11,000 or $2,200 per year. Now, if you're a charitably inclined individual, that's really nice for you to know. You might even be able to give that extra $2,200 to your favorite charity because you saved that money that you normally wouldn't have. Or you can keep it and use it for other living expenses. The other advantage that a lot of people don't take into consideration, sometimes it's a little bit tricky, is the Medicare rates, the insurance rates that you pay do go up if your adjusted gross income goes above certain levels. In this case, at $180,000, they're above the threshold for the first increase in Medicare premiums. So instead of paying $144.60 for Medicare premiums, they're paying $202.40 if they don't do any planning. You multiply that by 2 and by 60 months, and you're saving another $6,936 just by reducing your adjusted gross income by that $10,000. So the total savings is right around $18,000 by doing a little bit of planning and talking to your advisor about giving through your IRA instead of writing checks out of your regular checking account. Very effective strategy. The next example I want to go through again is the other piece that I think anybody under the age of 70 should be considering. It may not work if you're not as charitably inclined as other people, but in some cases, if you are giving enough to charity, it can be extremely effective. So in this example, we've got married taxpayers again, $160,000 in adjusted gross income, 22% marginal federal tax bracket, and they're both under the age of 65. Again, total giving $50,000 over 5 years. And in the example, we'll start in the column with 2020. We have our itemized deductions. So this one, I'm really just illustrating the difference in the deductions we're taking and then multiplying that by our marginal tax rate. So for 2020 state taxes, we are capped at $10,000 again for the real estate and state income taxes. Again, we have a small mortgage, about $4,000 of mortgage interest, and we're given $10,000 a year to charity. So standard deduction, $24,800. Our itemized deductions are $24,000. So we're going to take the standard, not getting any benefit again for that charity. In 2021, same thing happens. 2022, same thing happens. 2023 and 2024 as well. So the total deductions for that 5-year time period for these taxpayers is really the standard deduction times 5 or $128,000. If you do a little bit of planning and use a donor advised fund, which can be really simple and straightforward once it's established, just like I said, it's just like using your online banking. You would have the 2020 $10,000 of state taxes again, mortgage interest of $4,000, but we would try to accumulate and fund a donor advised fund for a 5-year time period. I generally talk to my clients about that 5-year time period or looking out at how long it might be until they reach age 70 and a half, because if it's 6 years or 7 years till they reach 70 and a half, we might want to include a couple extra years or maybe do 3 years and 3 years instead of 5 years. But 5 years is generally a good number. So by doing this in that first year, we generate $64,000 in itemized deductions versus a standard deduction of $24,800. So of course we're going to take the higher of the itemized deduction, $64,000. In the next 4 years, we're not going to give to charity out of our regular checkbook anymore, but we're going to continue to give to them out of that donor advised fund because we can spend that money over 1 year, 2 year, 3 year, 5, 10 years, however long we want. But effectively, we could give that $10,000 per year for the next 4 years. not take a deduction for it, and we still end up with 167,200 in total deductions over that 5 years versus the 128,000 in the no planning example. The increase in deductions is $39,200 at 22%. We're saving ourselves $8,624. This example is a pretty simple illustration. I didn't want to get too complicated. One other strategy, as we talked about earlier, that you could utilize here is instead of giving all cash to charity, you could give either an appreciated stock or a combination of cash and appreciated stock. But if you give an appreciated asset, and just as a simple example, you give a stock that you've held for 30 years that's got a basis of $10 and a market value of 100, you can give enough shares to get to your $50,000 mark and at fair market value, and only and you don't have to pay the capital gain tax on that $90 capital gain on any of those shares. So you would not only get this $8,624 tax advantage, you would also avoid having to pay capital gains tax on $40,000 or $45,000, whatever the math would work out to, at about 20%, 15% federal, 5% state. So you could save yourself maybe another $9,000. So similar to the previous example, instead of $8,600 of savings, it could be closer to $16,000, $17,000. So lots of different things we can do with just a little bit of time spent on planning and a little bit of time talking about it. Hopefully these examples have illustrated enough of the tax savings that can be garnered. As I referenced earlier, if there's additional questions or there's additional things that you'd like to discuss in any of the other areas I touched on but didn't spend a lot of time on, you're welcome to reach out to me at the email address on the screen and or pick up the phone and call our office, and we'd be happy to talk it through. Just wanted to make sure that we were all thinking about these strategies. Life gets away from us sometimes when we forget about taxes. And if we just take a little bit of time during the year to talk about some of these things, we can save money for ourselves and or allow ourselves more funds to be able to give to the charities that we hold near and dear. Okay, I'm still not seeing any questions in the chat, so I am going to end the presentation and watch for that email with the link. And if you have any additional questions, please feel free to email me directly. Thank you.